Imagine it is late 2026. The headlines are no longer warning about a recession. They are documenting a collapse. The global debt crisis has moved from the spreadsheets of central banks into your grocery bill, your mortgage, and your retirement fund. This is not a theoretical scenario being debated in academic journals. This is the lived reality of 160 million American households in the most financially turbulent year of the modern era. The US dollar has lost over 25% of its purchasing power in just 3 years. The Federal Reserve's balance sheet has expanded to levels that would have been considered science fiction a decade ago. And the average American family is spending 42% more on essential goods than they were in 2022. The numbers are not abstractions. They are the difference between stability and survival. In moments of absolute systemic panic, humanity always looks for a lifeboat. For 5,000 years, that lifeboat was a heavy yellow metal pulled from the earth. Empires rose and fell. Currencies were debased and abandoned. Wars were fought and lost. And through every single moment of civilizational chaos, gold remained. But today, in the digital age, a rival has emerged. A decentralized network of math and code that claims to be the new gold. Is Bitcoin truly digital gold? Or is it just the world's most sophisticated, high-risk tech stock in disguise? In the 2026 recession, one of these will protect your family's future, and the other could evaporate in a liquidity crunch, taking your net worth with it. Today, we are stripping away the influencer hype and the corporate marketing. We are looking at the cold, hard math of the AI economy and the death of traditional fiat currency. From the Lindy Effect of physical bullion to the network effect of the blockchain, we are finding out where the smart money is moving before the 2026 bubble finally bursts. This is not an opinion piece. This is a forensic investigation of the two most important monetary assets of our lifetime. Welcome to the Wealth Compass. Let's begin. Gold has no CEO. It has no marketing department, no headquarters. No quarterly earnings call where an executive can disappoint the market with a single sentence. And most importantly, it cannot be printed into existence by a desperate government at 3 in the morning. As of 2026, central banks across the globe, from China to Poland, from India to Singapore, are accumulating gold at the fastest rate since the 1970s. In 2025 alone, central banks collectively purchased over 1,100 tons of gold. These are not retail investors acting on emotion. These are the most sophisticated institutional actors on the planet, and they are choosing gold. Why? Because gold is the only financial asset in existence that is not someone else's liability. When you hold a US Treasury bond, you are trusting the US government to honor that debt. When you hold cash in a bank account, you are trusting the bank to remain solvent. When you hold corporate stocks, you are trusting management, markets, and macro conditions to align in your favor. When you hold a 1-ounce bar of 24-karat gold, you are holding 5 millennia of human consensus. No trust required, no counterparty, no risk of default. If the internet goes down, if the power grid flickers, if the global SWIFT system is weaponized as a geopolitical tool, and in 2026, all 3 of these are no longer theoretical risks, your gold bar remains a gold bar. It has zero counterparty risk. It cannot be hacked. It cannot be frozen by a government executive order. It cannot be inflated into worthlessness by a central bank printing decision. In a world where every other asset class is built on a foundation of trust in human institutions, gold stands entirely alone. Let's look at the psychology of tangibility. In a 2026 recession, when digital numbers on a screen are fluctuating by 10% an hour, the human brain seeks the physical. It seeks weight. It seeks something it can hold and verify with its own hands. This is what economists call the Lindy Effect, the idea that the longer something has survived, the longer it is likely to survive into the future. A technology that has existed for 10 years can be expected to last another 10. Gold has survived for 5,000 years. It has outlasted the Roman Empire, the Ottoman Empire, the British Empire, the Soviet Union, and every fiat currency ever created by human civilization. The Lindy Effect suggests it will outlast every institution that exists today. Look at the performance data. During the 1929 Great Depression, gold's purchasing power increased while the stock market lost 90% of its value. During the 2008 financial crisis, gold rose 25% while global equity markets collapsed. During the 2020 pandemic, gold reached an all-time high of $2,070 per ounce, while economies shut down across the planet. In every major systemic crisis of the modern era, gold did exactly what it was supposed to do. It preserved wealth. But there is a silent problem with gold in the modern AI economy. You cannot send it across the world in a second. You cannot verify its purity without specialized equipment. You cannot divide it into microtransactions. And you certainly cannot buy a coffee with it during a flash crash. Is gold's greatest strength, its physical nature, becoming its ultimate weakness in a world moving at the speed of light? Even the plain bagel often reminds us that gold is an insurance policy, not an investment in the traditional sense. It doesn't produce cash flow. It doesn't pay dividends. It doesn't innovate. It doesn't compound. It just sits there, unchanging, immovable, and eternal. In 2026, where the cost of living is skyrocketing and every idle dollar is losing value daily, is just sitting there enough to keep you ahead of the curve? Now, enter the challenger, Bitcoin. Born in the wreckage of the 2008 financial crisis from an anonymous mind that called itself Satoshi Nakamoto. Designed from its very first line of code to be everything that the banking system is not. Transparent, decentralized, and above all, mathematically scarce. In the words of Economics Explained, Bitcoin represents the first instance of absolute scarcity the world has ever seen. Not relative scarcity, absolute scarcity. Land can be reclaimed from the ocean. Gold can theoretically be mined from asteroids in the coming decades. Even the US dollar can be created with a single keystroke on a Federal Reserve terminal. But there will only ever be 21 million Bitcoin, period. Not 21 million and one, not 21 million and a fraction, 21 million. Encoded into the protocol forever, unchangeable by any government, any corporation, or any force on Earth. By 2026, we have moved completely past the magic internet money phase. We are now in the era of institutional adoption at a scale that was unimaginable 5 years ago. BlackRock, the world's largest asset manager with over $10 trillion under management, holds Bitcoin ETFs. Fidelity offers Bitcoin in retirement accounts. Multiple sovereign nations hold Bitcoin on their official balance sheets. When the most conservative financial institutions on the planet are allocating to Bitcoin, the magic internet money argument is officially retired. Think about the efficiency argument. You can move $1 billion worth of Bitcoin across the globe, from New York to Tokyo to Lagos, for a transaction fee of less than $50. It arrives in minutes. No correspondent banks, no SWIFT fees, no currency conversion spreads, no government permission required. Try doing that with gold. You would need an armored convoy, a cargo aircraft, weeks of insurance underwriting, and customs paperwork across multiple jurisdictions. The logistics alone would cost more than the transaction fee for $1 billion Bitcoin transfer. Bitcoin is gold with wings. It is gold that you can memorize in your head as a 12-word seed phrase and carry across any border in the world, invisible to any scanner and immune to any confiscation. It is gold that settles in minutes instead of weeks. It is gold that can be divided into 100 million pieces for microtransactions. It is gold that any person on Earth with a smartphone can access, regardless of their government, their bank, or their credit score. But there is a catch that has destroyed more would-be Bitcoin investors than any bear market in history: volatility. In early 2026, we saw Bitcoin drop 30% in a single weekend because of a regulatory rumor coming out of one government. 30% in 48 hours. Can your nerves handle a 30% drop in a significant portion of your net worth while the broader economy is already in a recession and your job security is uncertain? That is the Bitcoin tax. If you want the generational gains of the future, you must be willing to endure the psychological chaos of the present. Most people say they can. Very few actually can when the moment arrives. What actually happens when the recession storm makes landfall in late 2026? Not the theoretical recession that economists debate on television, the real one. The one where margin calls are triggered, credit markets freeze, and panic becomes the dominant market force. We need to talk about the correlation theory and why it is the most dangerous concept that most investors have never heard of. Historically, in the first stage of a market crash, everything gets sold, even the good stuff, even the safe stuff. Why? Because when large hedge funds receive margin calls on their failing leveraged tech positions, they cannot sell the thing that is crashing. Nobody is buying it. So they sell their most liquid, most valuable assets to raise cash. They sell their gold, they sell their Bitcoin, they sell their index funds. This is the liquidity trap, and it is why, in the first 30 to 60 days of a major crash, almost every asset class falls together regardless of its fundamental quality. In the 2026 stress test, gold plays the role of the slow and steady winner. After the initial liquidity shock passes, gold recovers first and fastest. It doesn't make you wealthy overnight. It doesn't generate the headlines that Bitcoin does, but it stops you from becoming poor. It acts as the anchor in a portfolio that would otherwise drift into catastrophic loss. In a full-scale recession, the asset that loses least is often more valuable than the asset that gains most. Bitcoin, however, is the wild card that every serious analyst is watching in 2026. The critical question is whether Bitcoin is moving in correlation with the Nasdaq as a risk-on speculative asset, or whether it is finally beginning to decouple and trade as an independent monetary asset. By 2026, we are seeing the early evidence of that decoupling. As the AI economy expands and institutional adoption deepens, Bitcoin is increasingly behaving less like a technology stock and more like a systemic hedge against monetary debasement. The correlation between Bitcoin and the S&P 500 has dropped from 0.7 in 2022 to 0.3 in 2026. That decoupling is not complete. but it is accelerating. We must analyze the stealth tax of monetary inflation as it applies to both assets. If the Federal Reserve is forced to print trillions of dollars to bail out the banking system again in 2026, and all historical precedent suggests they will, gold will rise. It has done so in every single monetary expansion event in modern history, without exception. But Bitcoin? Bitcoin, with its fixed supply and its growing institutional base, could experience an asymmetric explosion in value that would dwarf gold's percentage gains. But you must ask yourself a fundamental question before you allocate a single dollar. Do I need a shield, or do I need a sword? Gold protects what you already have. Bitcoin captures what is coming next. In a full-blown 2026 depression, the grip of the old system will tighten. Cash will be restricted. Capital controls will be implemented. Cross-border transactions will be monitored and limited. In that scenario, the permissionless, borderless, censorship-resistant nature of Bitcoin becomes more than an investment thesis. It becomes a survival tool for anyone who needs to move wealth across borders without asking permission. So, which one protects you in 2026? After analyzing the historical performance data, the institutional allocation trends, the macroeconomic stress scenarios, and the behavioral psychology of investors during crises, the answer is not one or the other. That is a beginner's mistake. That is the mistake of someone who is thinking in binary terms about a fundamentally complex problem. The Wealth Compass strategy is about being anti-fragile, about building a portfolio that doesn't just survive volatility, it strengthens from it. Gold is your shield. It is for wealth preservation in the face of systemic collapse. It is the money of our ancestors, tested by 5,000 years of the most extreme conditions human civilization has ever produced. It is the asset you hold when you need absolute certainty that something will still have value tomorrow, regardless of what governments decide, what central banks print, or what technology disrupts. Bitcoin is your sword. It is for wealth generation in the face of monetary debasement. It is the money of our grandchildren, built for a world of digital finance, borderless transactions, and mathematically enforced scarcity. It is the asset you hold when you believe that the old monetary system is in terminal decline and the new one is being built in real time. In the 2026 economy, a truly protected and growth-oriented portfolio needs both. The Wealth Compass recommended allocation for the current environment is a 70-30 split. 70% of your hard asset allocation in physical gold or gold-backed instruments, providing stability, preservation, and the psychological confidence to endure volatility. 30% in Bitcoin, providing asymmetric upside exposure to the greatest monetary revolution since the invention of paper currency. One protects you from the system failing. That is gold. The other protects you from the system inflating. That is Bitcoin. Together, they form a complete monetary defense against every scenario that 2026 can throw at you. As we navigate this recession, remember a fundamental truth about wealth preservation. Diversification is not just a financial buzzword invented by advisors to justify their fees. It is the oldest and most battle-tested risk management strategy in human history. The merchant who carried goods in multiple ships understood it. The Roman general who never committed all his legions to a single front understood it. Don't wait for the total collapse of the dollar to decide where your loyalty lies. By the time the collapse is obvious to everyone, The lifeboat will be full. Secure your position now. We have prepared a deep dive breakdown on the 2026 hard asset allocation strategy for our subscribers. Specific entry points, specific allocation percentages based on risk tolerance, and the exact custody solutions that protect your assets from both market risk and institutional counterparty risk. If you found this investigative report valuable, subscribe to the Wealth Compass. We monitor the charts, the macroeconomic data, and the institutional money flows, so you can focus on building your life instead of staring at a trading screen. The 2026 recession will be the greatest transfer of wealth in modern human history. Wealth does not disappear in a recession, it transfers. From the unprepared to the prepared, from the reactive to the strategic, from those who trusted the system blindly to those who built their own. Make sure you are on the receiving end of that transfer. This is the Wealth Compass.